Chad Moyer with you. We are at the Expo EDU stage of the Nebraska Ag Expo, and it's going on in Lincoln over a 3-day period. And this is Grain IQ. It's a project of the Nebraska Rural Radio Association and the Nebraska Soybean Board as we continue to talk markets and some of the things that are going on in marketing in 2024 and into 2025. It's a panelist conversation today. I am joined by Brugler, Marketing and Management, Elkhorn, Nebraska, and Darin Newsom, a grain market analyst. He's written for DTN, works for Barchart here as well, and these are our panelists. We're going to talk a little bit about what's going on in the markets. First of all, let's just get to know our panelists a little bit. Alan, we'll start with you. Just a little bit of background and what are some of the things that you do with your business and things like that. A little bit of background.
Well, basically, I've been in the ag marketing business for more than 45 years. I started out with Ohio Farm Bureau, then I went to DTN. I was Darin's predecessor at DTN as a senior market analyst. Started my own business in 2002 at Brugler Marketing Management. We've had clients in 17 states, worked with some large multinationals and also just small, even 400 or 500 acre farmers in some cases. I sold the bulk of the business to Austin Schroeder last summer. He's now the day-to-day operations manager. I'm doing more individual consulting now with farmers and speaking to audiences and that type of thing. But never found a dull day in the markets. There's always something new to look at and understand.
Yep. All right. Darin, same question to you. I know you mentioned that you've been a couple of different companies, have written for several different folks, but a little bit of background, kind of how you got into this business.
Yeah, I guess how I got into this, probably be unfortunate now looking back, but I mean, this is what I chose to do. Grew up on a small farm in Kansas, down southwest Kansas. Depending on who I'm talking to, I can't really call it southwest Kansas because Kansans will point out it's not. But south central Kansas, went to work at the co-op, and through the co-op they had their own little commodity office, and so I got interested in the trading and the brokerage and all of this sort of thing. So got my license, worked at a number of different places, moved up to become a grain merchandiser in other co-ops, and then went to work for DTN 20-some years ago, following Alan, and was there for a number of years. 2018. My son was done with college, and so we went into business together. I'm still doing all the writing and talking and this sort of thing, and he does the stuff that's hard. He's the brains of the network. He does all the algorithms on the and in the trading algorithms on the investment side. So I look at markets, he looks at the investments, and it's been fun. It's been fun. You know, I always get folks who want to work with their kids. It's been enjoyable. I get to learn something from him. Just the other day, customer called, asked about crypto. I immediately passed it to Ben. I have no idea. So it's fun. I get to learn things every day.
All right. Good to have you guys on the panel. Thanks for agreeing to do this with us here today. Let's just start by kind of taking a half a step or a step back and just kind of remind ourselves where we're at. We'll start with you, Darin. Just, in the last month, 2 months, 3 months, kind of summarize what has brought us to where we are late in 2024 in the grain markets.
Yeah, I think the biggest thing to me, particularly if we kind of narrow our scope down to say corn and soybeans, by the time we got to mid-August, the real fundamental factors, the real fundamental reads on the U.S. corn market, they had been growing more bearish over time. But by the time we got to mid-August, everything started to change. And we started to see the spreads starting to cover less calculated full commercial carry. We saw commercials starting to do more buying. We saw basis starting to firm. And so this has been an interesting, it's been an interesting evolution over the last number of months, that now we actually are looking at a bullish supply and demand situation for U.S. corn as 2024 gets ready to end. And when we can look at that all the way out through the 2025-26 spreads, and it's the same scenario. So that, is telling me we have seen strong demand. And as we look ahead to 2025 plantings, the markets again are saying we need more corn acres, more than soybeans. Will it change? Right now, it's not changing our fundamental read. So it's going to be interesting. Once we turn that calendar page to 2025, do the wheels fall off? Does everything blow up? Do we start over? That's the scenario that we've seen develop over the last number of months, and that's where we are as the year gets ready to come to an end.
Alan, what are your thoughts? Again, kind of bring us up to right now. What have been the major things that the market has had to chew on to get to where we are right now?
Well, again, we had, as he mentioned, we've got a record corn yield, record production for this past year. Now, we've benefited from South America having some weather problems on their half of the cycle, particularly their first crop corn a year ago. So that's what's helping us have the strong exports that we have coming into the fourth quarter here for corn. Soybeans are sort of front-end loaded on their exports in that China's trying to get some in before there's any potential trade disruptions in 25. Bean market's a little more of a struggle here because we're looking at a much bigger carryover in stocks usage ratio, 470 million in the December WASDE. And we're looking at world soybean carryover stocks that are 20 million tons higher than we'd like to see them. So beans need to have the price cheap in order to stir up more consumption. Corn is trying to ration a little bit here, but as Darin alluded to, the soy-corn ratio for new crop has dropped down to 2.29, which is saying plant more corn next year and less beans. Mm-hmm. If we do too much of that, we're not going to like the corn market.
And maybe, Alan, to follow up on that, the structure of the market that we've seen right now, you know, the values that the market is offering today versus carry to March, carry to May, carry to July. I don't remember in recent history, at least I feel like, that it's been this flat. What does that indicate?
Well, if you have full carry, which we're nowhere near, that's the market trying to allocate supply over time. It's saying we don't need all the bushels now. We've got to reward somebody to keep them for later. When those board carries are smaller, the market's saying there's a better short-term demand scenario, and you need more of it to move up front. We're not at inverse market either. We still have a carry to March, but it does suggest that there's a little more demand right now. And this is the time of year when we should have more demand, or more consumption, more sales, because if you look at world supplies, this is our 6-month window. I talk about a 2-season marketing year. There's our 6 months to sell most of our North American production, then there's the South American 6 months. Yeah. So this is when we should be seeing the most interest in our commodities.
Yeah, and Darin, maybe would you comment on that too? Just what is at play right now, you know, with the carry and the basis, and it's kind of giving us the structure that we see late in the year.
Well, I knew it wouldn't take long for Alan to bring up the WASDE, so I mean, there's that. As you know, I don't look at those numbers. They're make-believe. That's fine. I mean, if you want to say X number of billion bushels left over, or whatever yield was, it doesn't make any difference. But it comes back to what you're asking, Chad. And as I opened with, the change in these spreads has been interesting. Whether or not we actually had record production, nobody's ever going to know. I mean, let's be honest. We don't know what the yield was. Nobody knows what the total yield was. But we did see, again, up through early August, that the commercial side of the market, those who are actually involved with the underlying cash commodity, they were comfortable. So they were, you know, as Alan said, they were putting pressure on the nearby in relation to the deferreds. But all that changed once we got into August. Is it a South American issue? Is it a U.S. issue? Again, I think we have, as Alan pointed out, we have seen a good deal of demand come into the market. Now, I'm not going to say that, you know, this isn't necessarily the case in corn, because I think it is. Who's the largest buyer of U.S. corn? Well, one of them is Mexico. And we know what that situation is going to happen. That thing's going to blow up here in a little bit. So Mexico's loading everything they can right now. The first 6 months of the marketing year does usually not focus on the corn, on U.S. corn. Soybeans are the biggest thing that move the first 6 months. Corn moved the second 6 months. This time around, corn's moving more because one of our biggest importers, the importers of U.S. corn, doesn't like what it sees looking ahead. So as far as the spreads go, we know we've got strong demands chewing on supply. That's what the weakening carry in the spreads is telling us. That's what the strengthening basis is telling us, is that it's immediate demand. And again, we'll have to see how long this lasts. The difference, as Alan pointed out, is this is the scenario that we see in corn. It's not the same in soybeans. While the nearby future spreads are more bullish, again, because of short-term demand, further out as we start looking out the May, July, and so on, when South American crops move center stage and the U.S. takes, its customary secondary place on the global stage, that's where we see the biggest difference between corn and soybeans. It's just not that bullish out in beans.
All right. Let's talk about the 8,000-pound gorilla in the room, and that is the election in 2024. Because I think as we as Americans have a pretty short memory. I think that's a pretty fair statement. So I'm going to draw on your guys' historical perspectives. Darin, you were at DTN 8 years ago when then-elect Trump was ready to go into office. Is it the same as it was going into his first term as the attention that's being given to that presidential election is this year?
I think so. I don't see any difference. The only difference is it's more heated now. 300% tariff, whatever it is, that's supposed to be coming on Mexico, increasing, already tariffs that are already in place against China and who knows who all else. Probably, we'll probably get into another trade war with Canada and Japan and who knows. Everybody that buys from the United States is probably going to come under the gun because they can at this point. That's just the way it is. There's no safety valve now for U.S. agriculture of a possible election 4 years down the road. That's gone. So the way I look at it, agriculture is, and really will be a pawn in the big game of chess, and pawns are expendable. And that's the view. That's the view coming from the president-elect, Washington in general, and so on. And we wrote about it at DTN back in 2016. I've been talking about it ever since. We had to take a step back. Isolationism never works. It just doesn't. Not when the rest of the world is working together. You can't set yourself out on an island and say, we're not going to deal with anybody. It makes it tough. So yes, I think the scenario is very similar to what we saw back in 2016 and probably going to be amplified this time around.
Okay. What are your thoughts about the election and the influence that has had on marketing grain?
Well, first of all, I have a little less pessimistic viewpoint of the upcoming situation than Darin does. I think quite a bit of this is negotiating leverage. They're talking points. You're trying to create red herrings, which you're creating something you can give that you pretend to care about and try and get something real in exchange for it. Okay, there's definitely going to be some trade war friction here. But I want to remind people that the supply doesn't leave the world. Okay, world production is world production, world consumption is world consumption. What we're talking about mainly is when you get to ship your product and who gets stuck holding the hot potato. If you remember the children's game, you pass around the hot potato, you don't want to be the one holding it at the end. That's the ending stocks. Ending stocks are expensive to carry. You don't want to be the one carrying the ending stocks. So, China is less dependent on the U.S. for soybeans this time around because of the expansion of South American production. But the thing you also have to remember is that a lot of manufacturers have shifted their sourcing. They're not as dependent on China as they were in 2017. You got more supply out of Vietnam. You have more supply out of other places. Not so much grain, but for manufacturing goods. And the fact that the incoming president said we're going to enact all these tariffs doesn't mean that we know what the knock-on effects are. We don't know how China will react exactly. We know what they did last time, but we don't know if they'll do the same thing. Tariffs are a tax. They can be paid by the buyer or the seller. China's economy is very weak right now. They may, in fact, lower prices on some goods to offset the tariffs because they need the sales.
Sure. All right. We'll come back to that idea of what might happen, try and play out a few scenarios here in just a moment. But we really haven't talked about, I think, world events that have kind of that have added to the condition that grain marketing is in right now. So, Alan, we'll start with you. What are some, years it was the Ukraine-Russia situation. Is that still a part of it? Is it weather in South America? What else is going on around the world that is having an impact on marketing grain?
Well, the big impact on the Russia-Ukraine situation is the numbers are no good. Darin and I go back and forth on how good USDA numbers are, and whether you need them or not. We agree that the Russian-Ukraine exports and production numbers are no good because Russia's counting the annexed territories as part of their production, and that makes their production look bigger. But then they exported illegally under ships with no tracking devices on them. So those numbers are not good. Mm-hmm. Wheat market's very dependent on Russia, though. What they're willing to sell for, how much of an export tax they're willing to add on, how much they want to ration their supply in the following year. The other part of that is, of course, we have quite a few sanctions on Russia because of that activity over there. They've bypassed them. It's creating a problem in that they're getting some of the third world countries to ally with them in various degrees, whether it's Iran or China. They've attempted to expand the BRICS group of countries. There's been loose talk about it creating a currency to compete with the dollar. That isn't going to go anywhere. But yeah, it does complicate trade for the U.S. because you're forcing some of these buyers that we depend on to pick sides.
Yep. Would you pick another world influence, Darin, if you would, and kind of expand on it? What else is going on around the world that is having an impact on our marketing of grain?
Yeah, I certainly will. I just want to add one thing to what Alan said. And the second thing that's going to happen, my guess is the second thing that's going to happen after inauguration is the sanctions will be lifted against Russia. That's going to happen. And so that changes that game a little bit. You mentioned, to me, when we look at the situation that we've put ourselves in, it puts a spotlight on the idea that production agriculture is, and it doesn't matter if we're talking about what crop we're talking about, it is a weather derivative. It is all dependent. It is majority dependent on what happens in weather. And we've seen this play out in the softs. We've seen, skyrocketing coffee prices, cocoa, sugar, orange juice, all of these things that are all tied to weather situations around the world, be it, as Alan mentioned, Vietnam or Brazil or the Ivory Coast for sugar, not for sugar, but for cocoa. So to me, as we go into 2025, knowing that we're going to be a secondary player on the export game, it's all going to be who has the supplies. Alan's right. Who has the supplies? And what's going to determine where those supplies are? It's not trade, it's not currencies. All that stuff doesn't make any difference. It's weather. If South America has weather, U.S. is out of the game. If South America has problems and they don't have the production, the U.S. is back into the game a little bit. And we're going to see this in all kinds of markets. We're going to, as I said, we've seen it play out time and time again in the softs. We're going to see it in the grains. Wheat, I don't hold out much hope for that. It didn't really get much of a bolster with this, Ukraine-Russia situation. The world just isn't interested in U.S. wheat. Russia was taking its grain, as Alan said. Alan laid it out perfectly, moving it around the world, taking Ukraine's grain, moving it around the world. So the wheat's basically just going to be what the wheat market is. Corn and soybeans is where, as usual, where the focus is going to be, and it's all going to come down to weather, whatever part of the world we're looking at.
Okay. We haven't talked about outside. You kind of alluded to it, the outside markets. Are there other things like the energies and energy policy, crude oil, renewable diesel, SAF, things like that? Are there other outside things that are at play here too? Darin, we'll start with you.
Yeah, I think so. We also know that the upcoming EPA is not ethanol friendly, so that's going to be interesting to see what happens there. It's more petroleum friendly. Now, the question becomes, okay, OPEC plus. which includes Russia. That's why I have to mention the OPEC Plus, because Russia was a big part of what's going on. Are we going to see the production cuts come to an end? I can make the argument either way. From a global supply and demand point of view, there really isn't any need for OPEC Plus to bring those production cuts to an end. Is it a possibility based on what's happened politically around the world? Yes, it could happen. It could happen. We've seen this sorts of things before. So, if we look at energies, again, from a fundamental point of view, crude oil is still bullish. We still have, the future spreads are still telling us that it's a bullish supply and demand situation, but the market can't go anywhere. So it's an interesting play in the global energy markets. And other things, we're also looking at global stocks. So many people want to talk about global equities and these sorts of things. How long can this run last? I mean, the last 4 years have been big. We've seen stock markets do wonderful things. If all of a sudden everything comes unglued, not just in the U.S., but around the world in global stock markets, then what? Where does that money go? Where does it move to? And I think those are all things we're going to have to deal with.
Yep. What are your thoughts, Alan? And maybe we can include the financials in that too. The dollar, gold. We've had several record-setting days in the financials. So what else is in play?
Oh, don't forget Bitcoin 102,000 either.
Well, there you go.
Cryptocurrencies. Don't try that at home, folks.
No.
Well, Darin's already pawned off crypto. We know where that lies in him. But yeah, go ahead. Yeah. What are some of the other outside things?
I want to start with one of his themes, which is the stock market's been on a heck of a run here. Asset allocation suggests that you would start to back out of some of those positions to try and find undervalued assets to invest in. The question is, what are they? All right, real estate's still a little spendy here in the United States. Interest rates, I'll get to that in a second. But if you see a little asset allocation or rolling of positions in the stock market, that frees up some cash. Commodities look cheap, but you don't really have the big inflation play, which is when the Wall Street folks would tend to put a lot more money into commodities. Having said that, I do see some hints of inflation here not going away. The market's still looking for the Fed to cut interest rates 0.25% in December and then kind of take a pause. Some of the recent CPI and PPI numbers would suggest they shouldn't even do the 0.25 point cut in December, that things are perking along a little too well. So what's that say? It means the interest rates, that the cuts that we think are coming down the road may be slower to happen. Interest rates may stay higher longer than we're thinking, say, in September. That has implications for storage costs for grain. Okay, it means selling, time value money, you maybe sell a little earlier just from that perspective. Going back to the inflation though, if the inflation runs a little higher than with the base case scenario, that's actually good for commodities. Now, I'd throw out the dollar here. The dollar's been very strong since the election. That's a little complicated in that it doesn't help ag exports if it's strong, right? You'd prefer it to be weak. Now you look, who's it strong against? Well, one of the countries it's strong against is China. The yuan renminbi is bumping along 10-year lows against the dollar right now, and which means because they're trying to stimulate their exports. But that does make imports of U.S. goods more expensive for them. It does kind of favor them going to Brazil and other third-party countries.
Well, very good. So I think we've talked enough about the past and kind of where we're at right now, late in the season in 2024. Let's turn our attention, gentlemen, and look forward now. And kind of what I want to do with this is I'd like you to each in your mind kind of think about as we get into 2025, we're looking to market grain, and we can talk old crop or new crop. But what's a best case scenario that you see playing out? What is the worst case scenario that could happen? And then I'm going to ask you guys to pick one of those and defend which do you think is actually going to happen. So, Darin, I think we'll start with you. Give me, what is your best case? What could happen that would be positive for marketing grain in 2025?
Okay, so you're asking the person who has a reputation for being the most pessimistic analyst in the business, what is the best case scenario?
Yep.
Maybe that we actually are all around to see New Year's Eve 2025. That might be the best case scenario. But in all seriousness, it's what I mentioned earlier. Let's say that El Nino really intensifies across South America, and particularly Brazil, and it just decimates their crops. And despite the self-imposed tax the U.S. is getting ready to face by way of tariffs and trade wars, which raises domestic prices, not foreign prices. If we can get through that, and if some of the world's buyers are forced to come to the U.S. door, that's the best case scenario. So the best case scenario for U.S. agriculture is to have a disaster somewhere, anywhere, everywhere in the world. Because otherwise, then we're looking at the worst case scenario. Nobody wants U.S. grain. And we know how to produce grain. We can produce corn, we can produce soybeans, we know we can produce wheat. But if nobody's interested in it, all of a sudden, that creates a problem. So the best case scenario is devastating weather around the world.
Yep. What's in your mind? What are the elements of a best case for marketing grain here, out of the United States for the Nebraska and surrounding area producer?
Well, first thing to remember is the prices do move around. Okay, the average trading range in soybeans since 1980 has been just around $3 a bushel in a marketing year. So far, we've done a little over $1. On corn, the average range is $1.52. We haven't seen that extent of volatility yet. So there's room to the upside on both of these markets just due to normal price variability. Best case scenario on the current marketing year for beans, which is now through next August, if you just had that average move, you'd touch $11 on the high. Now, I'm having trouble coming up with a scenario to do that when we've got this big a carryover. It may not be an average price range year, but the bullish scenario on beans would be some kind of South American problem because they're the major exporter. They're bigger than us now. On the corn side, I think stocks are tightening. Ending stocks are tighter than a year ago. Yeah, we can argue about the WASDE numbers, but we do know that if stocks are tightening year over year, most of the funds don't want to go short. All right, so particularly the more traditional, well-established commodity funds, they're adding longs when stocks are tightening. They're adding shorts when stocks are getting looser. Yeah, so the bear scenario is we have a big acreage in corn this year, and we get a good yield again, and the world doesn't really want that extra production. I don't want to look past the biofuels though. Darin referred to the EPA as maybe not being friendly in the new administration.
I think we both know it's not.
But I want to think about just the EV versus conventional fuels argument. Okay, if you just back off the EV stimulus, that's friendly for conventional fuels, which by definition includes the blended, renewable diesel and the E15. Mm-hmm. All right, it may help us sell more of those products just because you're not pushing everybody to EVs. Now, they were not that friendly the last time around when it came to exemptions for various
like
plants.
Halloween candy.
Yeah, but it's better than continuing the heavy subsidies on the EVs, which we assume are not going to happen under the next administration. So. The big gorilla there is SAF. Does EPA do anything under the next administration that makes it easier for us to create corn ethanol that can be used for SAF? Right now, the hurdles are pretty stiff. As you know, you've got to have a cover crop, which some parts of the country can't do. You've got to have some other hoops you have to jump through.
Sure. All right. You've both kind of done a little bit of elements of the worst case, but is there anything else in a worst case scenario that at least kind of are the possibilities, or at least should be on our radar that could potentially happen going into next year? Alan?
Well, the worst case to me is simply where we are in the price cycle. Okay, short crops have long tails. You had a bull market in 2022. You had 10-year highs just like you did in 2012. We're equivalently in 2014-15 window now. And that was not quite the low in the corn market or the bean market. So, and you look at the world stocks and beans particularly, the downside count off that head and shoulders top would be 730, folks. Okay, and we're at $10. So that's the bear scenario: is we just keep having too much production, whether it's U.S. or South America, versus consumption. And price has to work lower to get you to move that product or come up with new uses for it, or make bean oil work for renewable without the subsidies or something of that nature. That's my bear scenario. And corn, you get to 350. Doesn't sound as bad, although you're not going to make any money there.
Yeah. Darin, quickly, any other elements of a bad scenario?
Yeah, I want to build on something Alan said. He's talking about funds. And what we've seen is they've built this long in the corn market. And we've rallied the market, 50, 60 cents off of that. But if all of a sudden the fundamental picture changes down the road and it doesn't look quite as rosy for them, or as good a place for them to park some money, and they start pulling out of the market, then you have no fundamental reason for the commercial side to be buying. You have the funds pushing the market lower as they're getting out of their longs. This could create a huge vacuum in the market that would be possibly the worst case scenario. It would actually take it down, as Alan's been talking about. It would actually take it down below what we would imagine for the low end of the range, just because there's nobody stepping in and buying. So, from the corn point of view, this net long futures position by large investment traders, it could be a concern. Yes, it's bullish for now. It's bullish right up until the point it's not, when they start selling again.
We have gotten to that point in the program where we're going to have you guys ask some questions. Are there some things that have been talked about today, or something that we haven't talked about that you would like our experts to talk about? And then we can expand on that a little bit more. Bryce, I think you have one up here in the front row.
Yes, Iowa State grad. Okay, so I did this class, and I asked the monitor to put in corn prices in an AI situation, and when would be the best price to sell. So you said your son is working with algorithms, but I don't know if he's working with AI. But what we came up with, based on we put in Naomi Bloom. I think she's pretty good. So, but it came up June 16th would be the best time to sell corn for 2025. So I'm wondering if you're working with AI to predict prices now.
What is it?
Yeah.
Either of you have experience with AI?
Yeah, the answer is yes. I'm using Gemini, I'm using Copilot. I will share, I was in a webinar environment yesterday on that subject, and the commentator said, well, I wouldn't trust it for anything that really matters. Okay, if you're gaming, if you're trying to come up with ideas, this current state of AI is pretty good for that. But you still get what they call hallucinations, where it just gives you bad data. He suggested that you actually tell it, take a breath before you answer. Tell it it's okay to give you a slower answer, because sometimes it considers more data when you do that. I thought that was an interesting perspective. Okay, think about your answer a little longer before you give me what your answer is. But I'm going to tell you that if that's the answer you got, that June 16th number, that's probably heavily influenced by seasonality. You look at some of the price patterns in the past. We've got a spring low to summer high. What's the average rally? What's the average number of days? What's the average number of new highs? and it's normally going to come up with something in late May or June. So the AI was probably leaning on that data pretty heavily if you're looking for a time type target.
Sure. Darin, have you worked with AI, and how has that influenced things?
Yeah, like I said, my son does he does all the algorithms, but let me put it to you this way. Predictions, AI, Alan, me, anybody, Naomi, it's foolish. It's completely foolish. There's no predicting the future. We know that. It's a ridiculous waste of time that we have to do every year, this time of year where everybody wants predictions for the next year. Chaos theory tells us there is no way of making accurate predictions. I mean, we can make them. There's absolutely no guarantee it's going to happen. June 16th, as Alan said, great seasonal number. Put it out there, certainly. $5 in corn, perfect, sounds good. I remember a few years ago, somebody came out and said, $8 corn. Didn't give a time, didn't give a reason, $8 corn. If he's right, he's a genius. If he's wrong, nobody cares. Nobody's going to remember. So yeah, I mean, we can make predictions. I'll say, I'm going to use, instead of AI, I'm going to use DI and say $20 soybeans, $10 corn. And you can take that away and you can write it. It doesn't mean anything. What's the situation? How are the markets changing? What are the chaos events? And we know there's going to be chaos events. How does this change things? Chaos changes everything. And the more chaos you introduce to a system, the harder it is to predict. That's simple. We know that. And we're looking at a time where there's going to be nothing but chaos each and every day. So make a prediction off that. Have AI make a prediction off that. It'll be fun to watch.
So is DI, is that Darin intuition?
You can use the I for anything you want to use it for.
Gotcha. What other questions do you have? Yes, sir.
So you talked about front-loading exports a little bit. How else might you reconcile that 24 corn is inverted over 25 corn? We all know your place on USDA. Is there less
I
corn?
think this question's for me, Alan.
Well, or both. But I mean, how else would you explain that 24 is inverted over 25? Because that shouldn't normally happen.
Well, actually, it should. In one hand, you have an orange. On the other hand, you have a grapefruit. They're similar. They're both citrus. They're similar. But they're completely different. 2024-25 has its fundamentals. 25-26 has a vague idea of what fundamentals are going to be. It doesn't have a really good clue yet. Yes, they're both corn. Yes, they're similar, but they're completely different. So what we're looking at, why does 2024-25 why is it stronger in relation to 25-26? Because we know more, we think we know more about what's going on right now. We can see the demand. We can see the future spreads. And as we look, as both Alan and I have talked about, as we look at that Nov bean Dees corn spread, we can see that the market itself is trying to buy more corn acres away, or trying to buy more area for corn acres. So if you add all of this up, there's no reason for the 25-26 market to be building into a premium right now until we see weather develop or something else change.
Yeah, and then you put it in that context of the short crop long tail, the multi-year swings in corn. A 51 or 56 month cycle used to be what we talked about, which is a little over 4 years. It's just long enough that if you react to what you did wrong last year, you're wrong again. Okay, you can do the math on it. All right, so, but the point being there, if we're not quite yet to that cycle low, you're also going to tend to discount the future until you get there. Okay, and you have to assume this early. You have to assume trend line yields when you're making. If you're doing an S&D for that year, you can pick acreage numbers based on the soy corn ratio or whatever, but you have to assume trend line yields unless you know otherwise. Darin was talking about probability and chaos, and the black swan is another way of discussing that uncertainty out there. But Nassim Taleb, the guy who who promoted the black swan concept, which is that there's things that happen that nobody thinks are even possible, also said that we tend to try to over-optimize systems. We try and protect against the risks that we know to the point where we're not in a position to take advantage of a positive surprise when it happens.
Sure.
And that those happen more frequently in agriculture specifically. The outlier, that 1% chance of happening, actually happens much more often statistically than it should because of that over-optimization.
Any other questions?
Sure. So I should have asked it the first time, but it seems we have a coupling of maybe inverted, feels like also especially stronger basis. Do those things combine increase the chances of a futures rally coming into May and June, or is that just a head fake?
No, I mean, because those are our real fundamental reads. If we've got firming basis and we've got the carry getting sucked out of the market, those are real fundamental reads. We don't need to worry about make-believe fundamental reads. These are our real ones. And they're telling us that this could push the market up. It could push the market up through the end of 24, but then does it change once we get to 25? If not, yeah, then we can continue to build on this. Funds might continue to add to their net long instead of start selling it off. So yes, but that's the building blocks. That's where you have to start, because if you don't have that, then you don't really have the structure of a market to continue to build a long-term uptrend.
Okay. I think there was a question up
right
front here.
I was going to ask, there's a lot of chaos among our energy producers in the world. Some might get more stable, some might get less stable in the coming period. How does that typically affect commodity prices?
Alan, start with that.
Well, I think it adds to volatility, okay, but volatility in crude oil is just, you know, your price range is $20 a year, or it's $25 a year, or $30 a year, okay? The thing that people overlook in crude oil production is offline capacity, okay? Things that are on paper, OPEC's going to produce this much, but how much are they underproducing because something happened? You know, a refinery or a storage tank in Libya gets bombed because they're still fighting a little bit there between two factions. All of a sudden, some of that capacity is offline. They're not meeting their quota. The Syria thing right now is going to mess up some supply chains, okay? There's pipelines going through there. What's it do to ag? It helps us a little bit in that the ethanol or the biofuel, the soy oil that you're producing is sitting here in the United States where it's needed, when it's needed. Now, if you have enough crude oil production coming out of Russia or whoever, then crude prices go down and it doesn't pencil so well, right? But it is still a sort of energy security to have that production capacity, as long as we don't lose money so long that we shut down the plants.
Darin, any ideas?
Yeah, it's a great question. It really is, because you know, in the grand scheme of things, the commodity complex, traders, investment community has, and as Alan talked about earlier, they have optimized these different market sectors for different levels of chaos and uncertainty. And in the energy sector, they have had to build in constant chaos, because we're talking about the Middle East. That's where a lot of the oil is from. Even though the U.S. has become the world's largest producer of crude oil, the Middle East is still vital, and it's just always chaos. And so the market has that built in, which is what's fascinating, is that we're just trolling along here. All of this stuff's going on all over the world: Syria, Russia, Ukraine, blah, 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 everywhere. The situation in Israel and so on. And yet crude oil, neither Brent crude, the global market, or West Texas Intermediate, the domestic market, can do much of anything. It's because they have that built in. Now, when we get to local markets, when we do things, when we pull on the horns and we just look at what's going on in the U.S., as Alan said, we can see more volatility. But the global markets have built in this idea of chaos. And now other market sectors, grains, financials, treasuries, are going to have to go back to where we were in 2016 to 20, where they're going to have to build in the expectation of increased chaos every day. And so does that dull the markets a little bit. It's a possibility. We saw that last time, particularly in stock markets, where they quit going off every crazy, quit reacting to every crazy social media post and just ignored it. We may be getting there again much quicker than we did last time, because chaos does have that effect on the markets, as you pointed out.
I think we are very close to wrapping things up. I have one question that I want to leave with, but I'll give you one opportunity. Is there one other question from the crowd that you would like to have these guys answer? Really quick.
Okay, Mark Gold last week predicted that we would be all corn and South America beans. So I don't know. I mean, it's an interesting chaos theory. Okay.
Yeah.
I just know if there's any alternative crops for us.
It's okay. It's another prediction. The U.S. all corn. We've heard this for decades. U.S. is going to be all corn. South America is going to be all beans. It's not going to happen because some of South America's biggest customers want corn too, and they don't want to buy from the United States. We're not going to tell everyone. I mean, think about the system that implies. It's the communist system. You're going to plant this. They're going to plant this. Is that where we're headed? Is that what Mark Gold is saying? It's not going to happen. It's not going to happen.
See, I think it's interesting that we mentioned Mark Gold and the lights just go away. It's like there's a sign or something. You have any thoughts on that scenario?
I just point out one thing that is happening, though, is we are ramping up our renewable diesel production. We're ramping up. We're adding more soybean crush plants. North Dakota got another one online here recently. We've been anticipating for 2 or 3 years now that the U.S. is going to be much more, for the soybean markets, be much more focused on domestic processing. Okay, so a bigger and bigger percentage of our production will be used here for biofuels, depending on the subsidy structures and energy. But the point being, South America will get more of the whole bean export market under that scenario. Now, where it gets interesting is if they have a crop problem. The world's very dependent on their exports, and now it needs to pry our beans away from crush to go into export. That's where your bull markets are going to come from.
All right. Well, we've got to the end. It's the host's prerogative to ask the last question, so I'm going to ask these guys the last question, and then we'll wrap up. So the question to you guys is, we've talked about all these big idea concepts, right? And what is influencing the market? What's the push? What's the pull? What's worth its value? What isn't worth its salt? So bottom line, to the farmer in Nebraska and surrounding states, what should he or she be doing to fortify their grain marketing plan? I know you can't predict everything, but you can do things, right, to help yourself in marketing grain going into the next year. And we'll start with, since we went this way at the beginning, we'll start with Darin and come back. What should we be doing? What are things that we can be doing on our farm right now to try and give us a chance at marketing grain?
That's a good question, Chad. I don't have a good answer for you, but it's very simplistic. And I had this conversation with a gentleman yesterday. Regardless of what we see, trends, this, that, and everything else, if you can make a sale, a small sale, to cover input costs for now, looking ahead to next year, make some, because we don't know what's going to happen. Keep some back, yes, because we don't want to sell everything. But if you can cover costs, if you can cover some of your input costs, do it. It's better to, in this scenario, it's better to do that than it's not.
Alan, what do you think?
Yeah, it's an old saw, if you will, and that is know what your production costs are, first of all. But remember, you got fixed costs and you got variable costs, all right? You got to at least cover your variable costs or you shouldn't even plan, right? Maybe you don't be so generous with your vacation allowance in a year where you're not making money, but or the new equipment budget. But again, Darin's point's well taken. If you've got that opportunity to cover some of your input costs where you know you're going to make them, that's key. In a more inflationary environment, and we still are more inflationary than we were in 2018 or 2017 or somewhere in there. the biggest risk is getting squeezed between your cost and your selling prices. Okay, if one's moving and the other's not, and you can be selling at a low price when you got high inputs locked in because you already booked them ahead for year-end discounts and what have you. You can also have the opposite happen where you locked in your price too low. So try and manage that. And space selling does work. It doesn't give you the highest. You're not going to hit the high of the year, but spreading out the sales spreads out your risk. That's just the bottom line.
All right, very good. Just a couple of housekeeping items. We've talked about it before, kind of knowing your cost of production, and this is not an endorsement, but it is just to let you know there are resources out there. The Center for Ag Profitability at UNL has, I think, 84 different crop budgets now up on their website for, corn on corn, soybeans, irrigated dry land, no-till, minimum till, up and down, all sorts of different crops. And like you said, they break it out into what are your fixed costs, what are your variable costs, what are some things that you might not necessarily think of, and you can use that at least as a starting point to get you going in that right direction. So cap.unl.edu is a great way to see that resource. Again, this was a part of a podcast. Grain IQ is a project of the Nebraska Rural Radio Association and the Nebraska Soybean Board and your soybean checkoff through ruralradionetwork.com. If you'd like to hear some past episodes and things like that about grain marketing and some of the things we kind of dive down into a whole bunch of those different topics. So wherever you get your podcasts at or at our network website, ruralradionetwork.com, it'd be a great place. Thank you for being here. Before we leave, let's give our panelists a nice round of applause for coming out here and putting yourself on the line, if you will. Thank you, guys. Appreciate it.
Grain IQ is a production of the Nebraska Rural Radio Association with support from the Nebraska Soybean Board. It is brought to you in part by Nebraska soybean farmers and their checkoff. Grain IQ is hosted by Chad Moyer and produced by Rebel Saklocha. It is written and edited by Alex Makovica. Our project manager is Bryce Duskett. You can listen to Grain IQ on Spotify, Apple Podcasts, or online at ruralradionetwork.com.